TGIF, NFP, ABCDEFG. How's everyone doing? Ingmar, Richard, Alexander, Sinatra, Mary, everyone's doing okay? All right, so what a wild week, wasn't it? Okay. Everyone see the Dixie? Give me a Y if you do. Got it, buddy? Okay. So I'm just thinking for a scalp. I may try to sell a rally with stops over the high if we get a strong number. I'm not declaring this a dollar top, and it could possibly not work if we get a 3, but I'm going to try it. It looks weaker than the yen. Actually, yen looks like we could blow to another high. Who's in the house with me from the team?
Hello, good morning. I'm here.
Hi, Stel. How are you? So, wow, 2 days in the S&Ps.
Yeah, as I said on the chat room, my bias is still firmly bearish in equities, you know, the markets are starting to catch up with the fact that rates are going higher, yields are going higher. We had today the ECB, a couple of members. One was what?
No. I had very few things to talk about this morning. And
okay.
You'll say in front of my train. Say what anyway. No, I'm just kidding.
Morning, yields are going higher. TGIF, man.
No, please
inflation.
Go inflation.
Sorry, yeah. Inflation is going higher everywhere. We saw Tokyo core CPI today. Tokyo CPI, sorry, year on year, 2.5%. Up from 1.3. So even in Japan, we're seeing inflation. And okay, in the Eurozone, we know inflation is there. Reported inflation is over 7%. And we are now starting to see, sorry, Blake, starting to see people, doves within DCB calling for action.
Hikes.
Yeah, action. There has to be action. I've been saying this for days and a couple of weeks now. I'm usually a bit early. You guys know that, but
that's what your wife said.
That's what she said. Yeah, and
Blake's got a whole stand-up routine lately.
Yeah, thank goodness it's Friday, guys.
We have an inside week, Stel. So I mean, technically, if we sit here with this range, the most bullish thing the euro could do next week is take out this week's low, last week's low, and then reverse and possibly put in a bullish candle after, you can say one thing with all the carnage, it's unchanged. You still have a blue candle, neutral inside week. So maybe we're getting closer.
Yep. I've said for a while now, I think the ECB has to turn, and I think the euro is going to have a nice tailwind as a result. Maybe we're getting there. I mean, I don't know, obviously.
So, Stelius, we had the ECB. Dale, do you want me to take over the charts? Because I actually want to go through a bunch of. I'll just take over a little early. By the way, K-Man, just if you guys are. Well, first of all, we're missing a few people today. Steve, I'm not sure where he's at. But Ryan is in Germany watching soccer. Sorry, guys.
Soccer.
Football. I'm sorry. I'm so sorry. You guys are watching. He's watching. He's out there watching football in Germany. And then K-Man, who loves to be here, and he's not here right now. His audio power is out right now, so I guess his audio would be out, so he's having a power issue, and that's
sucks.
It sucks. I hate that, and the timing couldn't be worse. The thing is, Dale, where we live, if you guys don't see, right now it's 5 o'clock in the morning, so based on where I'm at, but when I get up at in the 3 o'clock hour or whatever, I remember my old house, power would go down, my internet would go down, because they're we're doing services, maintenance, because no one's awake but you, right?
Yeah. That happened. That's what's been happening here. I didn't know it. They didn't say it was maintenance, but that's Anyway,
it happens. But anyway, so we're missing some of our teammates, but fortunately we got Stelios here, we've got you here, we've got me here, and we're going to go through the charts. But I want to point this out because Stelios, you were talking about the ECB, and you were talking about some of these hawkish comments. I mean, look at like Nagel's comments here, and there's Vice right here. A lot of like very hawkish commentary coming from the ECB. Now we do have a lot of Fed speakers today, don't we, Stel?
We do have the usual Fed talking heads, yes.
Yeah, so let's talk about that because here we go. We've got I think Waller speaking, Williams is speaking. Let's see, Bostic is speaking today. So we have there's Waller, there's Bullard, of course, Daly speaking later. Lot of Fed presidents, and I actually had Mark Chandler and I were talking about it. He goes, "Oh, by the way, you said Fed governors." He's like the regional presidents, just more of a technicality. And I'm like, good point. I don't know my nomenclature that well as far as just naming all the Feds. And but I'm actually interviewing Joseph Wang a little bit later, Dale. So I'll probably be
nice.
I'll be asking him about a bunch of Fed stuff a little bit later today. But I just want to say that we're probably going to get a lot of hawkish commentary out of those Fed, regional Fed presidents and whatnot. So what do you think about that? I mean,
there is a risk now. Okay, so we got the negative GDP print last week. If we get a weak payrolls number, remember ADP was weaker than expected a couple of days ago. If we get a weak payrolls number, I'm not saying they're going to react straight away, but you can bet that they're going to hint or in their own special way, give us, a bit of both sides. So it's not going to be all out hawkish. I think we might get a little hint on what could happen if things continue to or deteriorate, blah, blah, blah. So I think we're starting to get closer to the level where the Fed starts disappointing more and more. And we already had the 75 basis point basically out of the question. That was a small, yes, but still a disappointment. So I think now the risks are slowly adding up for them, taking another little step back and another little step back. Because they know they're hiking. They're hiking fast. Sorry, Blake. They're hiking fast, and 50 basis points hikes are quite aggressive, and they know that this is going to translate into the economy. It's going to lag, but it's coming. So how do they deal with that? I mean, I wouldn't want to be in their shoes.
Yeah, me neither. I wouldn't want to be either. And the market is pricing like a lot of people believe that a half basis point is going to be the norm until we're finished with this cycle, which is. You think about that would be, raising rates at a fairly neck-breaking speed at this point.
Yes.
I mean, maybe it's not. I mean, well, I guess it is, but this is the Fed. This is the problem when the Fed's playing catch up. The Fed is behind the curve, right? So when the Fed's behind the curve, they have to speed up their hikes, and that was the problem that they got in hanging on to the transitory narrative, which we all know. Now is completely wrong. But let me ask you, go back to the jobs report, and Dale, I'd love to hear your thoughts here. I'm in the camp that jobs matter. Now we had one of your guests, an English gentleman earlier this week, who said I disagree he was disagreeing with me about my comments about the non-farm payroll not mattering. He said it's actually the wage data. And I guess I should have been more clear. I care about the data that's coming out today. Data matters. It's the point I was trying to make this weekend is data matters. Especially this jobs data. When I say jobs data, it's the whole engulfing part of it. So what are your thoughts about the data today? I mean, we're expecting 400,000 jobs. Does the market want, like porridge, too hot, too cold, or just right? What do you think, Dale? What do you think, Stel?
I think that the market would like a weak number to take the interest rate pressure off it.
Hell yes. Hell
Yep.
yeah. But weak in what way? I mean, do you want a weak headline number? I mean,
Yeah.
we're expecting 400,000 jobs, roughly. Well, let's say we only create 250,000 jobs. That weak number is going to be, it's now we're getting back to that bad data is good for the market, bad for the dollar, right?
Yeah.
It's also going to be bad for the dollar.
I think the market would also welcome a weaker dollar.
Oh, hell yeah. Of course. I mean,
So
one of the
both
thorns,
of those things. Yeah.
one of the thorns in the market side is going to be the stronger dollar that we've had. So now let me ask Stel, what do you think as far as wage data goes? I mean, average hourly earnings, what if those start to weaken alongside the weak data? We start, you can see the average hourly earnings is supposed to come in at 5.5% versus 5.6%. Let's say that data comes in a little bit weak. I mean, do you want that data coming in weak with the headline number? I mean, with inflation, a lot of people feel that inflationary pressures are starting to recede. Like we've already hit peak inflation. A lot of people feel that way. I think the data is probably, coming in conflicted as far as that goes. But what do you think as far as the average hourly earnings?
Well, first of all, I would argue that the data is now a lot more important than it was, 6-12 months ago, because before we had the Fed, which was on hold, basically waiting to see how the economy and inflation moves. And now we have a set path. So data is going to be what determines how they change that path. Now, regarding average hourly earnings and payrolls and all that, I mean, if the problem is that we're going to see demand failure, demand destruction, because the average household disposable income is going down. Average rents and all costs basically are going up. Now, average hourly earnings have to match that. If they don't, it's a squeeze on the consumer. End of story. And already we're at 5.5% with inflation at 7.5%. So that's already it's already a squeeze which needs to change. Now, if that doesn't happen, then I think what we're seeing now is going to become worse and worse, and then inflation is going to come down, but for all the wrong reasons, because we're going to get into a recession, and you really don't want to see that.
We're in like a disinflationary environment type of thing. Yeah.
And the question is, we started with the notion that, this is not inflation is not coming, and then when it came, it's going to be transitory. Now it's going to be a little bit longer. The Bank of England, they said we're going to hit 10%, but it's transitory. I mean, how can you say that? We're going to hit 10%, but then we're going to go straight back to 2%.
What's the difference between, transitory versus inflationary? I mean, sticky. I mean, this is a whole conversation we get into, and I don't want to get into it right now, just because we got to get set up for the non-farm payroll that's coming out, the data that's coming out. But I'm gonna go round and round in circles. Like I said, I'm meeting Joseph Wang today. I'm also meeting with Mark Faber from the Doom, Gloom, and Boom report. I'll be meeting with him. I'm meeting with Jim Welsh. I got a lot of interviews coming up today. But Joseph Wang's going to be a really good one. Fed guy. If you guys don't know who he is, Dale had him on last Friday, I think it was, that we talked with him. He's going to be a perfect guy to talk about, inflation and, what changes the narrative. But I really want to talk.
He was right from last week, Blake. He said the long end is still mispriced, and look how much lower the bonds are again this week.
Yeah,
the long end. Yeah.
I'm going to take you guys into, this is the ForexAnalytix chat room. This is all, this morning. I'm going back to last night really quick. I want to share with you guys just kind of some thoughts here, but because it's important. What is this yesterday? This is somewhere yesterday. We were chatting, and May 6th. Okay, so somewhere around here. I don't know where the hell. I don't know where I'm at. You got to go back and back and back. But I was talking to I don't know where it is. I'll spend too much time looking around for it. But that's the ForexAnalytix chat room, if you guys don't know what that is. Anyway, I was asked yesterday, like, hey, Blake, what do you think about currencies? What do you think is going to happen, overnight? And I'm like, well, I think the euro is going to, get back above, 105.50, and the sterling's going to be back above 124. I think that, you're going to see a lot of these, the dollar upside pressure, kind of pull back a little bit as the market, gets ready for the jobs report tomorrow. That's basically my thought process. And you can see what has happened in the euro now. The thing that's really helped the euro today is obviously the Fed, the ECB comments that came out this morning that spiked the euro back above 105, close to 106. And I would say that right now the euro dollar is in a really very, very good range for us to trade out of. And let me get this, make this a little bit easier to see here. There we go. You can see that range is pretty, in my opinion, it's pretty well defined. Basically above 106 and a quarter, 106. I have it up to 50, but you can see 106 and a quarter, somewhere around here. This is previous, support at 106.30. That's current resistance. We get much above 106.30 to 50, and we get a solid break above that. You're not going to want to be short the euro anymore because that's a false breakdown. Okay. The flip side of that is, obviously the euro continues to trade very heavy as we are consolidating at lower levels. So a break below, 105 again, in my opinion, is going to usher in a whole new, wave of selling. So, and if you guys haven't seen it, just let me give you this. That's not the one. It's right here. I had removed it just to remove clutter. There it is. So one thing we do have to be aware of is there's a 261% extension that comes in right around, and actually if you take that, it's right around 104.60, just at fresh new lows. So if you get to a fresh new low and it looks like it pauses and reverses, you'll know why. It's a pretty critical extension of just the last move higher. That's why I care, because it's the last up move that we've had in the euro before the breakdown. So that is the 261% extension just at a fresh new low. So just be careful chasing it lower is the point I'm trying to make for today, especially following jobs. I don't trust jobs data farther than I can throw the jobs data. And so when I'm looking at, technically, and I see key levels just outside of, the ranges I'm looking for, I get a little nervous about trying to chase things, especially on a day-to-day like today. All right. So that's something I'm going to point out, that the euro is mid-range, but a move back above 106.30 to 106.50 is a bullish reversal. Now, I brought that up because the other question I got asked last night, for those of you that are following along this conversation, the other conversation I got last night is, how do I feel about the sterling? And I'm like, well, I think the sterling could get back towards 124. We can't even get up to 124. The sterling trades heavy. Now, it's got every reason to trade heavy. If you guys, remember like the central bank comments from yesterday from the Bank of England. Now, I'm going to say something because I want you guys to think about this. And this is like some comments I had yesterday with the ForexAnalytix traders before we hit a new trend low overnight. We hit the 161% extension. You can see how we hit that. But, when we were trading down here and I had people commenting to me, hey, when, the cables drop 300 pips, it's got to bounce. That was like comments that I got yesterday. And the comment, the rebuttal I had to give them is, when it's a central bank meeting, I try not to fade those moves, especially if they're, in this case, it's very impulsive. You see a move and then it stops and then it stays there. No recovery. That's because, if you look at any commentary, not one person out there would have told you that the Bank of England was hawkish. Not a one. Everybody's like, it's, they're extremely dovish and, oh my gosh, I can't believe they're as dovish as they are. And, the sterling broke down. So when currencies move because of a central bank, that is pure repricing. That is everybody that owns sterling or in one way, shape, or form going, shoot, I've got way too much sterling and I need to get out. I need to get out and I need to, reposition myself. So that immediate aftermath of the sterling going lower, even further than being down 300 pips off of those highs, didn't surprise me overnight to hit the 161% extension. I mean, now that we've done that, I cannot get bullish the sterling till you get back above 124. But if we see dollar weakness, come through the market in a big way, it could trade back above 124. I believe that the sterling was the reason why the dollar actually gained strength. If you guys heard my commentary yesterday, a couple of times I used the term domino effect. The sterling was the domino effect that actually, kicked over the euro, which kicked over the Aussie. And then, everybody looks around and goes, oh, shoot, and then the equity markets go, hey, guys, did you see that the dollar index is ripping this morning? Yeah, let me get out of stocks. And then the stock market rolled over. And then everybody's like seeing the stock market roll over. Then they looked at Bitcoin because it fell like a domino. It wasn't like all at once. It was like the dollar moved, started with the sterling, then the whole dollar index. Then the stock market opened, dumped. After that happened, gold moved. After gold moved, Bitcoin dumped. It was literally a domino effect. And that happens. When that happens, then there was a catalyst that was just a single catalyst. Like in this example was it's probably the sterling following the Bank of England, because the euro didn't fall until after the sterling did its second wave lower. So the reason why I bring all this up is because if the sterling does recover, it's going to probably be because the euro is breaking back towards 106, 106.30. But
yeah,
the reason
been a monster this week, Blake.
The what? The what?
Euro pound's been a monster this week.
Oh, it has been. I was thinking about shorting it yesterday, and then I thought otherwise because we are now above channel resistance.
87 coming.
Yeah, I mean, yes, I think it's entirely possible. So the reason why I bring all this up, and then Stelios, Dale, I'd love to hear your commentary here, is because I like to look at the market, and when I trade like jobs reports and I trade, interest rate decisions, and I just trade the markets just in general. I have what we put together this bias chart every day. With the ForexAnalytix community, we sit down, we break down all of these, instruments, and we notice what's bullish and bearish and blah, 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 blah. Okay. The reason why I do that is because I know that following the data, it's going to, one of two things are going to happen. The dollar's going to sell off or it's going to rally. Well, we could sit sideways. It could be like crappy data. And then we're all going to be stuck with, our thumbs in our butts going, this sucks. And, happy Friday, let's go drink a beer. But, more than likely post data, we're going to get some sort of move. If we get a dollar bearish move, I am all about buying the euro today. I don't have any euro exposure. I'm looking to actually buy the euro at this point. Okay. Because it's acting better than the sterling. The flip side of that is if we have really strong data, this sterling is already heavy. Now we have to be cognizant that we hit the 161% extension, but I'm going to take us longer term in this daily chart. I'm going to whip that out just a little bit and move this over. You can see it's kind of messy here because of all the numbers. There's a spike low back here on June 20th. And the one thing that you have to realize about the sterling is the pound sterling is not even close to the 2020 spike lows post COVID. The euro is well below that. The sterling, as I mentioned, last week, it's got some catching up to the euro. And if we start cracking that support, then, it just opens up another leg lower, to the 121, and change level. So keep an eye on the sterling. I don't think the carnage is over if we see more dollar strength. Now I'm going to lastly, and I'm going to take your comments here, Dale and Stelios. One of the other things I want to point out is the dollar index. I want to just go through just basic technical analysis with you guys. Look, this is the 2017 high. That's this week's high. We probed above it by like 20 pips or whatever. Okay. Now you'll notice that we dipped to 102.50 and we bounced like a bat out of hell yesterday. Why? Technically, why? I'll tell you why. Because if you take, let's get rid of this blue line here. If you take the high back here in the 2017,
it looks like a trend line break.
It is, and it's a trend line respect move this week. So you take the 2020 post-COVID high, right? And now you zoom in. Let me zoom in. Now you zoom in, and that dotted line, you'll notice it came in right at 102.50. Now I know we dropped to 102.20, but the fact of the matter is we're holding it. So if you want to turn bearish the dollar, like if you're a dollar bear, we have to break back below this week's lows. Now, what I think is happening, and I've told a lot of people this, Dale, is I think that we are in process of building a cup and handle pattern. I'm not a dollar bear by any stretch of the means. And if you were on the trade-off show with me and Chris Weston a little bit earlier this week, I think I mentioned it. I also talked about it a couple of different times with people. I think this is what we're doing with the dollar. Now, I may be wrong, and obviously the dollar could just completely, implode, or we could just implode, in a bearish way. It could implode on a bullish way, especially with headlines that everybody's trading on right now. But I do think that the dollar is going to remain bullish longer term, at least, over the next couple of months, because I think that the Fed is more aggressively hawkish than most central banks. But I think in the near term, we are at least going to be trying to deal with, grapple with what's happening here, whether, it is a pullback or not. I think that the dollar, you can't turn bearish the dollar until we break below 102.50. But really, it's like this week's lows. All right. And then obviously if a break above the highs, and look out, get out of the way, either get on the train or get out of the way. So Stelios, Dale, what do you think here?
I think you're right about if you bearish the dollar, you have to be, we have to break below that level that you showed. I personally am, and I'm talking about medium term now, so, months, years, maybe next year, I think the dollar is going to be quite a bit lower than here. So I think this is the last hurrah before we see a major move lower. But, we could complete that cup and handle and do another final push higher before lower. Now for the pound that you talked about. Sorry,
go ahead.
Were you going to say something?
I was going to say, I didn't cover the dollar yen, but I'm sure a lot of people are wondering about the yen. Like, is this going to be a good trade? Like somebody asked me yesterday, like, what do you think is going to happen with the yen? During the Fed, and I'm like, I wouldn't want to be on the short side of the dollar yen, and we bounce right back because I think there's too many other forces moving around the yen. So anyway, go ahead regarding the sterling.
Yeah, no, I was going to say, and I wrote this in the chat room as well. When your currency gets trashed, like the pound has been losing a lot of ground, that makes inflation worse. So that's going to be kind of an opposing force that will cause the Bank of England to be more hawkish. Can they ever be more hawkish? I think they can. So the more the pound suffers, the more we're getting closer to a reaction from the Bank of England. And so I think you're absolutely right. We're nowhere near the spike lows of 2020 in cable. So there's a good chance. And our friend Paul also wrote there's regional election results today in the UK, and Boris Johnson's situation could be worse than expected. So it's there are many reasons to
own the sterling.
Yeah, there are many reasons to not like the sterling at the moment.
No. Hey, regarding stocks, and Dale, you might want to chime in here. So, here's equities, obviously, and I'll go back to the chart.
We have 1 minute to the data, by the way.
Thank you very much. We have this, huge head and shoulder pattern. You guys have seen this chart 1,000 times over the last several months, those of you that are daily listeners. But as you know, I still think we have, some time to build out that right shoulder. I don't think it's, oh shoot.
I can't get short here, Blake.
No, it's tough. It's tough to get short.
I was surprised by yesterday's reversal, and it gave that much back, but I could be out, but I can't get short here.
I think it was more of a positioning, and people worried about what's happening with let me grab really quick 2 charts. So what I'm going to do, I got the S&P so we can see reaction. I'm going to go over here and pull up. I'm going to go over here and I'm going to pull up the euro, and let me zoom. Let me fix that chart. 15-minute chart, zoom in a little bit. So we'll watch the euro, and we're going to watch the S&P.
Put up data flash.
I will. Hold on.
All right.
Just getting there right now. So
All
I'm trying
right.
to do it all. Here we go. All right. There we go. Then, and you guys scream if you see the data. Oh, here we go. Canadian plant jobs stronger.
Okay.
Average hourly earnings lower.
Oh,
Month on month,
Whoa.
year on year, the same. Jobs
Whoa.
stronger, but revision slightly lower. So I think jobs number is not really going to do anything.
No, but look at the S&P moving higher. This is going to be a little bit weaker data. People are more focused on the average
wages.
hourly earnings right now.
Yeah.
Exactly. So I would not want to be short along the dollar right now. I think the euro could actually, make it.
Yeah.
Now the euro may not make a huge move. Oh crap. It may not make a huge move, but here we go. Back towards 106. I think 106. As you guys know, I think 106.30 is going to be a big deal. We're trying to make our way up there right now. But
how about yields?
Yields
coming off.
Yeah, here, let's pull up yields
And
really quick. That's the S&P. Let's go take a look at yields,
There it
which
is,
will
in
be
the middle.
really interesting.
Yeah.
They are coming off just a
Yeah.
bit. Here's a 15-minute
okay.
chart. And then watch the emerging market currencies. They have been really strong. I own pesos here, like right around these levels. Actually, I'm right around these levels. I own dollar mex, and the dollar mex is weak, and the Mexican peso is stronger. And I think if the dollar continues to be weak, you might see the dollar Mexican peso pick up a little bit of steam, especially if stocks continue to recover. So anyway, the data, it's a mixed bag, but I think a little disappointing because of the wage data. And we're seeing a little bit of volatility, but we'll see if we can get, we'll see if the market can move a little bit here. So, all right. Well, I want to say, hey guys, thank you so much for being with me and Dale and Stelios today. And I know we've been missing a lot of our team today because of, K-Man's power is out and Ryan's being a football fan. And, Steve is,
Is Steve gets AWOL?
I don't know. He's playing like doodly scribbles with his son, I think. I don't know. It's a Friday afternoon in Greece.
All right.
Stelios, I'm just happy you're here.
I mean, NFP market's crashing. What's a big deal?
No, he's like, no, I'm gonna go play hopscotch with my kids. It's cool. Well, his kid, that's fine.
He is one of the best at detaching. Like
he
can
is.
Really
he's
detach.
like when he goes dark, he's dark. All right. So anyway, you have an interview coming up, right?
Yeah, Dario Perkins. And I think Dario was on the BOE for a while.
I was going to say, I'm really excited to, Dario I want to welcome him. I'm actually excited to hear him speak. It's one of those,
cool.
There's people you bring on that I get super excited about. Dario is one of them. So make sure you guys and gals stick around. Thanks for being here every day. Remember, we're here on Monday, and I'll see you on the week ahead video over the weekend if I'm going to miss you. All right.
All right. Thanks team. Dario, you have to send Blake an 8x10 glossy autographed.
Yes.
I wouldn't say
that
far.
Nice to meet you.
Hi, good to meet you.
Yeah, really, I'm glad I reached out on Twitter. I'm not sure, Dario, if you're going to, was there anything you wanted to share on the screen, or at least we could use our faces and talk to each other with video?
Yeah, I'm happy to put my face up. I don't have anything that I particularly want to share.
Okay, I might have a few things.
Video.
Okay. So nice to meet you. Waiting to see you.
Oh, it says the host has stopped the video. I can't. You have to do it.
Okay. Okay. I'm wondering.
Yeah.
Yeah, and good morning or hello, Dario. I guess it'd be close to afternoon over there. I'm not sure if that is disabled or not, but you know what, Dale? It's good to hear his voice. And Dario, we're just happy to have you here. So you guys have
don't worry.
All right.
Yeah, Blake will get you set up in a much more professional way when you're on Trader Summit, and it's not live. So live is sometimes, like real-time TV. But, let's start with a little bit about your background, Dario. Was it true that you were had something to do with central banking in the UK?
Yeah, so I started my career at the Treasury, the UK Treasury, in the late 90s. I spent about 5 years there, and then I went to ABN AMRO, the investment bank, where I was doing European economics. And then after the takeover from RBS, and then the nationalisation, and then the banking collapse, I went back to the Treasury just for a brief 3-year period, where I was. They basically asked me to do a kind of a look back at the Bank of England, assessing where it had done well, where it had done badly, and then to think about this new financial policy committee, because we were creating a financial policy committee trying to learn the lessons from the financial crisis. And so it was about designing that and putting the tools together. So, I mean, I kind of I worked with the Bank of England, but I didn't actually work at the Bank of England.
Okay, so have central bankers learned from the last mistake, or have they compounded it?
Well, I think at the moment they're obsessed with a different mistake, which is the 1970s. Okay. I don't think that you could be a central banker now and not have this voice in the back of your head saying, you're doing it again, you're making the same mistakes they made in the 1970s. And I think, you know, the big kind of hawkish pivot we've had from all of these central banks over the last 3 months is really about that fear. You know, they want to get back to some kind of neutral as quickly as possible. They still expect inflation to come down. So that transitory view of inflation is still very much alive at these central banks. But they're very worried about what happens in, say, 12 months' time if they're still looking at inflation numbers, you know, 4, 5, 6%. And they're worried that they're going to have to do more to deal with that problem.
Well, you know, instead of raising rates, why don't they buy a plot of land and throw some seeds around and try and grow a crop and see how easy it is to bring down inflation?
Exactly. No,
I think they can't print it.
I think the issue here is that they believe their own hype. You know, for the last 30 years, central banks have taken credit for the fact that inflation has been so low. They believed it was about their own credibility. We had these kind of newly independent institutions. They believed that they'd anchored inflation expectations at very low levels. And now they see inflation breaking higher. They see inflation expectations starting to move. They're almost victims of their own hype. You know, they have to at least sound as hawkish as they possibly can. And it is part of that kind of mistaken belief about where inflation comes from. But I do think there's a big difference. So I heard some of the chat before I started talking, and you were talking about different currencies and the pressure that sterling is under, and the euro and the yen, and this kind of reverse currency war that it's
really sterling even more than the euro, because here's euro pound. You know, I think that, don't you think that this, Dario, could be an early tell for dollar turn, that as bearish people are on the euro, that it's outperforming cable, it's outperforming Swiss. That's a safe haven, euro Swiss. So
I think we're at, I mean, it sounds weird given where interest rates are, but I think we're almost at maximum hawkishness for those central banks. I think that this is non-Fed central banks. So I think that when you look at inflation and you compare it across countries, we're talking about a very different type of inflation. So the US, you can make the argument that the labor market is overheating, that wages are growing too quickly. You can see the relief that's happened this afternoon with the slightly weaker wage number in the US. But you can't make any of those arguments about Europe or Japan, because we're basically importing all of our inflation. So you look at, you know, inflation is about to hit 8, 9, 10% across some of these European countries, and yet wages are growing at 1%. So we've got this massive squeeze that's coming through in terms of real incomes. We've got this collapse in real incomes. And I think at the moment, you know, I think there's a bigger risk of a recession in Europe than some kind of secular outbreak of inflation. And I think the dilemma facing these central banks is very, very different. And it just doesn't make sense for the ECB or the Bank of England to be raising interest rates aggressively, trying to chase the Fed higher, when in fact, you know, they have a very different type of economy to the US. And yes, you know, I think there's they look at the 1970s, and I think they take this kind of false lesson from what happened with the Bundesbank. So there's this idea that the Bundesbank was the only credible central bank after the 1970s, that they kept monetary policy much tighter than everywhere else, and they effectively opted out of the great inflation. There's this phrase that's used in Germany all the time about the Bundesbank opting out.
The Deutschmark was a hard currency.
Yeah, so it was using. So you had a very strong currency which protected you there. But the trouble is that whenever they've had these same kind of dynamics over the last 30 years, so whenever they've had a big increase in energy prices or a big supply shock, and then they've had this worry about second round effects and wage expectations starting to pick up, whenever the ECB is hiked, because it's been trying to learn that lesson from the Bundesbank, it's always gone spectacularly wrong. So, Jean-Claude Trichet was the best example of this. He had this kind of excessive deference to the Bundesbank. He was obsessed with the Bundesbank. He didn't ever want to do anything that would upset his German-speaking colleagues. And, it led to some very serious policy errors. So you had an oil price shock in 2008, second round effects. That's what they were worried about. So they hiked interest rates into a global banking crisis. You then had 2010, 2011.
Well, Danny Blanchflower tried to stop them.
Yeah, so then you had the same dynamics again. You had that kind of oil price shock, and you had these wage expectations picking up. And then you had another ECB rate hike, which again turned out to be this disastrous error. And they ended up, with a kind of decade of negative interest rates and zero interest rates. So it isn't clear to me that if you try to follow the Fed higher and try to use your currency to shield you from this, it isn't clear to me that that's going to work. I think that could actually go spectacularly wrong. And you end up just compounding this kind of recessionary force that I think is building in the European economy. I mean, outside the US right now, the world just looks in a pretty nasty state. You've got China, you've got lockdowns, you've got a broken economy in China. The kind of Ponzi financed housing bubble that they had over the last decade is basically come to an end. So you've got.
How come we don't hear about Evergrande anymore, Dario?
Because I think that I think that the initial focus on that kind of Lehman's moment that everyone was talking about, back in the autumn, that was misplaced. It was never about some kind of precipitous collapse in China's banking system. It was more about a growth model for China that had basically broken. And so now they need a new growth model. And all they can really do is try to, export their way back.
Lockdowns are their new growth model?
Well, no, that's the very short term. So in the short term, this is all getting much worse. But I think, the natural end from this is
they are easing.
The RMB has to go down. They're going to have to use the currency to try and get some kind of growth going again once they emerge from this disaster. So you've got this big problem in China, which is very recessionary for the global economy. You've got this enormous problem in Europe, which is that we're just having this enormous squeeze on real incomes, and the economy over the next 2 months is going to be contracting in a pretty nasty way. And in the US, you have this very rapid tightening in financial conditions, which, even though I don't think this is the beginning of a US recession, I think you could get a growth scare in the US that comes from, some of the most cyclical parts of the economy beginning to slow down. So housing, consumer durables, that's effectively what the Fed wants. And
well, I did see a news story, Dario, that consumers here in the US, there already is some demand destruction. They're driving only when necessary. They've changed their habits on groceries, and I think there was something else that is a major change for them. So they're pulling in their horns. In other words, and even the best dirty shirt, which is what everyone's saying, the U.S. is the best lousy economy in the world. It's having impact here. I think maybe we're already in a recession.
I think the difference is that I don't think we're in a recession yet. I think Europe's probably in recession. China's probably in recession. I don't think the US is in recession. I think the US is definitely slowing down. But I think the fundamental difference here is that it's almost US demand for goods, which is giving you the US inflation, but it's also giving you the European inflation. So we're basically paying your prices. We're paying US prices for our stuff. And we're not, there's no excess demand here. There's no overheating in labor markets. We just have this enormous squeeze. This is effectively a cost of living crisis in Europe. And, on UK data, which is the longest series we have, this is the biggest squeeze on households since the 1940s. This is an enormous squeeze.
I heard it was like the second worst period as far as, like you were saying, lifestyle since the 60s, when there was a brain drain and there was a currency crisis back then, wasn't there? In the
it's a very nasty environment for the economy, and so we're in this weird position where the Bank of England is hiking interest rates, talking about inflation risk, and forecasting a recession. I think that just shows you how difficult this is for them, and I don't believe it's really credible for them to just keep being hawkish. I think part of this hawkishness is about this worry about expectations and wanting to do the right thing. But I think that those central banks are facing a fundamentally very different task from what the Fed is placing now. I mean,
can you explain the Great Resignation to me? How we went from supporting the millions of unemployed during the COVID crisis to now having a labor shortage and people leaving their jobs? Are they all trading crypto and they don't have to work anymore?
So this is I think this is the biggest issue for the Fed right now. And you listen to Powell, this week. What did he say? He said, well, we've had a lot of bad luck over the last few years. We've had wars, pandemics, energy shocks, food shocks, lockdowns. And he said, now it's our job to look at what the economy is going to look like coming out of this crisis. So he's very much focused on this imbalance between demand and supply in the US labor market. Now, that imbalance doesn't really exist in Europe. But from a US perspective, you've got two issues. You've got one, which is that demand for labor has recovered very quickly and has gone above where it was before the pandemic. But on the supply side, there's been a net loss of labor supply. People have dropped out of the labor market. There's lots of potential reasons for that. One of them is, as you said, the wealth has gone up, so a lot of people have retired. So there's been a big hit from older workers leaving the labor market. So there's this fundamental imbalance, and you've got Powell hoping to generate this amazingly soft landing, which has never happened before in history. This idea that the Fed is going to hike and eventually that's going to cause labor demand to go down and it's going to rebalance the labor market and wage growth is going to slow, but unemployment is not going to go up. So we're not going to have a recession. I mean, this is almost fanciful. The only chance they've really got of a soft landing is that inflation is going to have to come down by itself. You still have to believe in the transitory narrative to think that there's any chance of a soft landing. If you think transitory is gone and this is a secular inflation problem, and if you think inflation is going to settle at levels that are too high for the Fed, which I would say is probably above 4%, if it settles at 2 to 3%, I think they'd be delighted. If it settles at 3 to 4%, I think they would probably just about accept that. If it settles above 4%, history suggests that they'll then just ratchet up interest rates, and that will cause a recession. But in terms of what has caused this, I think some of it is the wealth, some of it is people dropping out of the labor market, some of it is related to COVID and will probably fade quite quickly. But one of the big things is the nature of the support that the US has pumped into its economy. So in particular, because there wasn't the kind of because there wasn't the social security system, you basically just made everyone unemployed in order to get the fiscal support. So you put everyone into the unemployment insurance scheme. So you created this big separation between workers and employers. And that didn't happen in Europe, even though we used similar levels of fiscal support, particularly in the UK, where the fiscal deterioration is basically the same as the US. We used a furlough system, which meant that you were still attached to your employer. And so to receive the government support, you received it directly from your employer. But there was no separation between workers and jobs. And that seems to have been a big factor in how this is playing out, because suddenly you've got the Great Resignation in the US. People are moving jobs. They're getting big wage increases from moving jobs. And that's just not happening in Europe. We've gone back to our old employers. And in fact, during the pandemic, the people that received those furloughs actually took a haircut on their wages. So usually these schemes paid out, people 80% of their wages. And so now their wages have gone up just because, the furlough schemes have ended. So it's been a very different type of policy dynamic. And when I think, when we look back on this crisis and we say who got it right, who got it wrong, I think the nature of the fiscal support, not just the absolute level of fiscal support, but the actual way in which the money was put into the economy, I think that's going to be a big factor in thinking about, what kind of inflation patterns emerged from this.
What do you think about all of this weakness in cable? When you look at it long term, do you think it's overdone? The sell-off in cable?
I think that a big part of this is, well, firstly, you've had these kind of head fakes recently because the Bank of England was hiking early, sounding very aggressive. It sounded like they were going to ratchet up interest rates very quickly. And then over the last few weeks, they've kind of stepped back a little bit and thought, well, can we really deliver on this? And so you've had this kind of softening in the rhetoric from the Bank of England. I think that's giving you these kind of ups and downs that we've had recently. I think that a big part of the story here is basically Brexit. That our trade position has just deteriorated so much after the pandemic and after Brexit. And also that's a problem in our labour market because, you've in the US, they've lost a lot of workers through less immigration. But in the UK, that's been particularly pronounced because, a bunch of EU workers went home during the pandemic. And then they thought, well, we don't want to go back there because they've just voted out of the EU. And so I think, we've got this kind of longer term deterioration in our trade position that is coming from the fact that we've just cut off our biggest export partner. And that's what you're starting to see in some of this data.
Okay. And how does what's happening in Ukraine factor into your thinking?
I think that at the start of this war, we were particularly worried about the financial repercussions of this. So
like Russian defaults?
Not so much Russian default, but the fact that there is a huge amount of financial exposure from European banks to subsidiaries in Ukraine and Russia. And so, you looked at the banking exposures and you saw that Italy had this big vulnerability. France had a big vulnerability. Some of the smaller European countries had this vulnerability. And then you were seeing the tensions in commodity markets, and you were getting these margin calls in oil and energy and all kinds of commodities. And we know that European banks are a massive part of global trade finance. So I think my immediate concern was about financial contagion from what was happening. And I think the fact that hasn't happened so far is a source of comfort. The fact that we haven't seen these big, nasty financial spillovers kick in Europe. For a while, some of this data suggested that we were on the brink of a European banking crisis. It was really looking quite dicey. That stuff has calmed down. Now I think we've got the kind of recessionary impact of this. So this is about energy and food prices going up massively. UK heating bills have just doubled. We're getting massively squeezed by this. And so when you're paying double on your energy bill, and your energy bill is already a big part of what you spend money on, then suddenly you've got far less money to spend on anything else. And I think that's what we're seeing in the data now. The next 2 months, we're going to get this big decline in discretionary consumption across Europe because people just don't have the money to spend.
It's
adding to the inflationary concerns as well. So you have this kind of stagflationary impulse as well, because some of these inflation numbers are going to hit double digits now. I mean, the Bank of England is now forecasting 10% inflation in the UK.
Okay, and will that be exacerbated if Europe goes ahead and bans imports of oil and less so in natural gas?
Undoubtedly, that's.
Are they going to do it?
It seems to be where it's headed. 2 months ago, the rhetoric on this was very strong. We won't do that. It's just been softening and softening. So I think that's almost inevitable at this point. And then they're going to try and speed this transition to renewables, but obviously that isn't going to happen quickly. So we're going to have this period where we had a taste of this during the autumn and the early part of the winter, when we were relying on kind of intermittent renewable energy, and it was causing this crazy volatility. And obviously, looking back, we now know what was happening. Putin was effectively cutting off the supply of energy and causing these shortages to give us a taste of what was to come, to try and warm European consumers up to the sense of what was about to happen. There was a lot of mystery about it when it was happening. Now I think it's quite clear what was going on. And that situation is only going to get worse. So I think if you're a central banker, I think you're looking at a massive energy price shock on top of an existing inflation problem. And then that's where this fear of the 1970s is coming from, because in the 1970s, you had massive energy price shocks, but you already had an inflation problem. And then I think central bankers are seeing these other kind of eerie similarities with the 1970s. So the second one is that nobody expected the inflation outbreak in the 1970s. Bond markets didn't see it coming. Economists didn't see it coming. Central bankers didn't see it coming. You'd had this very long cycle during the 60s where the Phillips curve basically flattened. We were able to get lower and lower levels of unemployment without any inflation. And then suddenly all of that changed. Suddenly we had this kind of vertical Phillips curve and this incipient inflation problem.
I think this is the 70s on steroids, Dario. Okay, go ahead.
Yeah. And then you had, famously, central banks were quite slow to respond because at the start they blamed it on transitory forces and, said inflation would come down and it was just food and energy, and then it turned out not to be. And so I think
we didn't have a food shock back then in the 70s. That's a differentiation. It's the first time we've had both an energy and a food shock simultaneously.
Yeah, and I think that's what worries the central banks, that they can see these kind of eerie similarities with them. But I would say that this is fundamentally different, because what the 1970s was really about, it was a conflict between workers and labor. It was effectively a power struggle. You'd had a kind of trend slowdown in productivity, and then you had this decade-long fight about who would pay for that. And the countries that had the kind of really serious wage price spiral, so the UK, the US, some of the Euro area countries, they were ones where you had this very militant workforce, and you had, series of industrial disputes, strikes. This went on for a decade. And the country that didn't have any of that was Germany. And it wasn't because the Bundesbank was so credible or because the Bundesbank raised interest rates a bit. It was because you had German unions that were effectively colluding with employers. You had these powerful trade unions, but they were coordinated. So they worked with employers. And so you didn't get that power conflict. And I think, the issue here is that we spent the last 40 years basically dismantling the economy that produced those wage price spirals. And I think it's very hard to see that coming back in that same kind of way that we had in the 70s. So I do think this is very different. And I think if central banks become too obsessed with these ghosts of the 70s, they're going to make some very serious mistakes, particularly in Europe, where the inflation is very different to the US inflation.
Okay, so in the last few minutes, what's the biggest takeaway from Dario Perkins about what type of world and economy we're moving into late spring, summer, and fall?
I think we have an immediate growth scare. And I think this is a global issue. I think all of the main parts of the world are going to be slowing down. I think that will take some of the momentum out of yields. It will stop central banks from being overly aggressive. This is probably our best chance of any kind of a soft landing. We get a soft patch in order to get a soft landing. That, I think, is the kind of most likely environment. I think that there is a fundamental difference between the US and the rest of the world. So I think this is naturally a strong dollar environment. I don't believe that central banks in Europe can be credible in terms of the policy tightening that they're talking about right now, particularly given the immediate recession risk. And I think that you have to worry about what a strong dollar does, because if you're a US policymaker, you're looking at this and you're saying, well, a strong dollar is exactly what we need. But I would say that the textbook view of what the dollar does is completely out of date, because when the dollar goes up, a lot of bad stuff happens in financial markets.
Emerging markets. I think actually the financial markets would welcome a weaker dollar.
Yeah, because what happens when the dollar goes up, what the economics textbooks forget is that everybody invoices in dollars and everybody borrows in dollars. So when the dollar goes up, you get a contraction in world trade, but you also get a contraction in cross-border lending. So you get this drying up of liquidity and financial intermediation. You start to get strains on global value chains because these are financed using dollars. And so net, this is the dollar going up is very deflationary for the world. And it doesn't rebalance anything. if anything, it compounds that gap between the US and the rest of the world, because it hits the rest of the world a lot harder than it hurts the US.
Okay, that was crystal clear. If you want to follow Dario, follow him on Twitter. Is that correct? At Dario Perkins?
Yeah, that's it. All one word, Dario Perkins.
Okay, and why are you on Twitter? You just like to share your ideas, and do you have a business model, or you're just out there trying to, keep people aware of narratives that aren't really helpful, and trying, basically communicate where we're at so that people can make better decisions?
I think it helps in terms of brand awareness. So I work for a macro consultancy, and it helps to be part of Twitter. But I think to me, it's more about sharing. So, I test ideas on Twitter. When I'm thinking about writing something, I put initial thoughts on Twitter and I get responses to that.
Right.
It's great for sharing information. So, there's lots of interesting charts on there. The latest academic papers go up there, reaction to what central banks are doing. I just find it really useful from a research point of view. Beyond any kind of profile raising that you may get from Twitter. I think it's just a really useful source, and I think that sell-side research, macro research, has been fundamentally changed by Twitter over the last couple of years, and it's been disrupted. And I think that we have to learn how to deal with that going forward.
Okay, what good is anything until it's shared with another?
Exactly.
All right, Dario, really, it's a pleasure meeting you. And why don't we talk again later on this summer, see how things are shaping up, both here in the U.S. and across the pond.
Okay, great. Thanks very much.
All right, everyone, Dario Perkins. I hope everyone has a great weekend. And the rest of the day, you could join the team in 14 minutes for the Morning Edge. We laid it all out on the court for you this week. Hope we're adding value to what you're trying to accomplish in a fairly difficult endeavor if you've been doing it for a while. So have a great weekend, everyone. Don't just count your pips, count your blessings. See you next week. Adios.